Welcome back to another episode. I'm your host, Ryan Richards, residential loan officer and real estate investor based here in Massachusetts. Today I'm bringing on a very special guest, Matt Ward, who's a financial planner based out of Worcester. He's with Ford Financial Services, and he and I work very closely with clients to help them get situated on their finances so they are prepared and confident when it comes time to buy their first house. In this episode, Matt and I dive into a multitude of financial strategies for budgeting, savings, and overall just things to think about when you're preparing for your first purchase of real estate. If these topics interest you, then we have a great show. Stay tuned for Matt and I's conversation to learn all about financial planning in real estate. So welcome Matt Ward to the podcast today.
Yeah,
Matt.
Thank you for having me, Ryan.
Yeah, thanks for coming on.
Of course.
I'm excited. This has been long overdue, you and I.
100%. Yeah, I've been looking forward to this for a while. Obviously been working together for, multiple years now, and I'm excited. So thanks for having me. I appreciate it.
Yeah, of course. And I know this is a topic that a lot of listeners will take some value in, and it's a conversation I have a lot of times with some of my clients in like the preparation stage.
Exactly.
Like around, what you advise from the financial planning perspective on just how to help people create savings goals, create savings plans, and then navigate, the multiple different options you have when you're setting yourself up for retirement and planning for your big purchases, which obviously that's what I talk about.
Yeah, exactly. There's a lot of overlap for sure between our two businesses, and that's why we've worked closely together, and we'll continue to and have some good conversation today. So
yeah, and it's nice to have a great partner like you too, so that when I do have a client who's like, hey, I just need some help getting myself in this position, or I would like to talk to someone.
Yeah.
So I think a lot of times people don't necessarily become self-motivated with that conversation because a lot of households don't talk about finances, and it's almost like it's this cryptic, scary conversation.
Sure.
But obviously, a lot of the wealthy households do have those conversations.
Yeah.
So getting people over to someone like you to have those conversations, I think, is super important.
Yeah, I mean, education is everything, right? Big reason why I got into the business, and I know we'll talk more about that. But
yeah, and if you don't mind, I'd love to. Obviously, I know your story, but I'd love for you to share a little bit with anyone listening about what made you want to get into financial planning, and how did you make that transition?
Yeah, I appreciate you asking that. I mean, for me, it's been the only career and role I've had since I graduated school. It's kind of all I know, but I got into financial planning really with multiple internships when I was in school, getting my business and finance degree. I interned for a couple teams of financial planners out in New Hampshire, a couple here locally in Worcester, Massachusetts area, and was fortunate enough to meet my mentor and now partner in business, Tom Valentine, when I was heading into my senior year in college. I always joke with him. I learned more from him in 1 week, maybe, of my internship than maybe some courses and other things maybe taught me. And I just, we were a really good fit together, both with our working relationship, but also out of work. He's a great family man. He shares a lot of the same values I have. And, he was really big on education. And that is also why I got into this business. You kind of touched on it already, but the lack of financial literacy that I experienced in my education growing up, it wasn't talked about in school. My family didn't talk about it too much either. Was a big reason I wanted to be able to educate people and help them make informed decisions that are going to help put themselves in a better position in the future. And it allows me to have a really strong impact on a number of different families throughout my career, which is a big reason why I got into the business. Other than that, the other, more kind of true to my family and myself reason was when I was growing up, as you know, Ryan, my father suffered a stroke when I was quite young, and I will just never forget the day that my parents' financial planner came to our house and shared with my mother that, my dad had done the proper planning and had some protection in place where, even though he had a stroke and was has been out of work now for 12, 13 years, my family's doing okay because he took the time to make sure he was prepared for the unforeseen. And, it allowed my family to stay in their house in Shrewsbury that I grew up in. It allowed me to still, go to college, and them to be able to at least, sort of help me there. And I just think that impact that gentleman had on my parents, and specifically that day, my mother, was really, really, really important. And I just thought, if I can make that impact on other families in my career, I would consider that a success. So all those kind of reasons, grouped together is a big reason why.
Yeah. And absolutely, I think, especially your dad being a business owner, it's so easy for people in that self-employed category to forget about financial planning, because they don't have a 401k, they don't have a yearly review, they don't have benefits, and so it's awesome that he, obviously put himself in a good position from that standpoint, which you remember is now a relief. That could have been a different conversation. So.
Yeah. So the only thing I was going to add, Ryan, is just our company, Forward Financial Services. So we're based in Worcester, Massachusetts. You have myself and that gentleman, Tom Valentine, I mentioned. We're the two financial planners. And, I've been there for 5 years now, building my own practice alongside Tom. We have two other women that we work with, Jen and Deirdre, who are great staff members. Our client service specialist, Jen, kind of handles all onboarding and applications, while Deirdre is more in charge of scheduling meetings, scheduling annual reviews. But that's our team in Worcester, and that's, who I work with on the day-to-day, and that's the team that we, help service a number of households in this area and really across the country when it comes to financial planning and retirement planning.
Yeah, that's I think we align really similarly on that aspect, where we have this smaller local feel with the office, but we're powered by some bigger resources behind us.
Yeah.
And I think that's a really nice pairing when you're providing service, because you're able to give a really high level of personal service, but have the resources to back higher quality, higher level and more streamlined operations, because you have some support.
Yeah, 100%. Going off of that, as you understand, so Forward Financial Services, there's four of us in the Worcester, Massachusetts office. We are a part of a larger agency based in Boston, Massachusetts, Commonwealth Financial Group. So really what that relationship is that Tom and I, we pay them to be advisors in their agency. And there's over 160 advisors in that Commonwealth Financial Group agency, but there's also 85 to 90 staff members that support the advisors and our clients, right? So we have an investment research team. We have an estate planning strategist on staff. We have a gentleman that works strictly with business owners when it comes to business succession planning, right? So, you walk into the office in Tatnick Square in Worcester, and you might wonder, okay, well, there's four individuals, how much can they provide, right? And what are their resources that they have? But we have this huge agency backing behind us that is really, really valuable for our clients, and helps us kind of take on maybe more than you would expect a four-person office to take on.
Right, and you still get the plus of the four-person office. If I call, I get Jen or you or Tom, and that's there's a lot to be said for that.
Yeah. I mean, the one thing we really pride ourselves on is we have really, really good relationships with our clients. Clients stop in, open door policy, and when you have a question around your financial situation, whether that's an investment account, whether that's I'm deciding to buy or lease a car, or why we're here today, maybe making one of the biggest financial decisions of someone's life and buying a home, right? When you call the office, like you said, you're getting Jen, you're getting myself, you're getting one of us, right? You're not going to be speaking to someone that you haven't worked with or been in meetings with for years. So
you have that familiarity and trust. That's what it's all about. But I think it starts with what you mentioned earlier, and that's something I definitely focus on too, from my standpoint, is the education first. Mm-hmm. So it's not just about giving someone the answers, it's about giving them the information to choose the answer they think is right for them.
Yeah.
And that starts to build that trust relationship, and then you do have those meetings, and they realize that you're working in their best interest to still advise them, of course. If they're leaning one, of course you're there as an advisor, but also to give them the information so that they can feel empowered to make their own decision and understand their financial plan, which same for the mortgage side.
Yeah.
I want to make sure my clients know their options, they know how mortgages work, they know the programs they're in, why they're in them, so that, that question, right? You're at a barbecue and someone's like, oh, you bought your house, what type of loan did you get? I got this loan.
Yeah.
Chances are the person who asked the question has no idea.
Yeah.
But you can be like, oh, I went with this program because of X, Y, and Z. They might only know an answer, but they can feel confident in telling you why they're in the program they're in.
Yeah.
Same with their financial plan.
Yeah, it's one of the most rewarding feelings, I think, as a financial planner. I'm sure you, like you just mentioned, deal with it as well within your career. But speaking to a client maybe a couple years later and them reciting back to you as to why they're doing something, what the strategy is, and why, you know, they're confident in it, is really, really, you know, something that I enjoy. And I think something we always say to our clients is like their role within our financial planning process is simply to just be a decision maker, right? And my job at the end of the day is to be that educator and help them make those decisions that are in their best interests by just educating them on all of their options, right? I think in today's day and age, there's so much information out there when it comes to finances, investing, retirement planning, that it's almost so different than 25 years ago, where you might have had to kind of sit with a professional like myself to get a good idea of like where to start. Whereas now there's just, you know, 10 different articles telling you to do 10 different things. And my job is to help kind of consolidate all that information that's out there and help you make decisions based on economic truth and economic logic, rather than maybe just, you know, an opinion-based article that's published by a certain company, right?
Yeah, absolutely. It's the same with real estate. You know, we see it all the time.
Yeah.
And I know that that's one place we obviously work really well together, is combining on the education piece to really get someone from a position of thinking about something to confidently doing something, especially purchase of real estate. So I want to talk a little bit about that and how we work together, so that people get an idea of some strategies you would recommend on how someone can save in order to purchase real estate. That usually is one of the largest barriers into real estate, is not having enough funds set aside. And I think there are some great programs that do help with that, but obviously you want to make sure your client's in a good position financially, so that they have enough money to buy the house, of course. Then they have enough money to own and live in the house, and not feel like the house is the only thing they can do.
Exactly.
So obviously, one point where we collaborate on with clients is at that point where they come to me, they get pre-approved. They're not quite ready. They don't quite have enough funds set aside. So for someone who's trying to buy a house in the next year or two, like what are some strategies you would recommend so that they can properly save to be in a good position?
Yeah, and I love this topic, just with the number of younger professionals that I've kind of helped redirect, and then obviously pass along over to yourself to you then guide them on qualifying for the right mortgage. And I think it really comes down, one common thing that I see people do is they graduate college, and what's their first big financial goal? As a younger professional, most people in their 20s, whether that's mid-20s, late 20s, early 20s, it's to buy real estate, buy a house, right? You want to move out, and maybe you rent for a little bit, but you rent for a few years and you realize that, those payments aren't going to equity built in a home, and you want to be that person that owns their own property, right? And a common mistake that I see is, if that is your biggest financial goal, well, let's get into your cash flow and determine what percent of your income you're saving to what specific account. And I think what I mean by that is, a lot of younger people, they graduate school, they get this 401k, they've never had a 401k plan before, right? And who do they typically go to for that advice on how much or what percent should I save to my 401k? Typically it's mom or dad, right? Mom or dad who wish they started saving at 22 and probably started much later, say, oh, save as much as you can. And that's not bad advice, right? You need to be saving for retirement, right? But a lot of the time people may graduate and begin saving 10, 15% of their paycheck towards a 401k or a retirement account that is not necessarily super accessible when it comes to real estate purchases. Yes, you can access the money. Yes, there are some exceptions for a certain dollar amount for a first-time home buyer. But obviously, we'd rather have that money in a non-retirement account where we aren't worried about early distribution penalties that you incur when you take money out before 59 and a half, right? So I think a lot of the time, kind of just getting into your savings and understanding, okay, what percent am I putting to my 401k? Let's say my employer matches 5%. Well, I'm putting 15% into my 401k. I would never discourage someone from utilizing that full employer match, right? Like, put that 5% into your 401k, but if your primary goal is purchasing real estate, then why don't we take that other 10% and start redirecting that to a high yield savings account or a non-qualified investment account that is gonna be there and is gonna be accessible for when that house comes on the market, or when your income's in a position where you are ready to be a homeowner.
Yeah, and I think, absolutely. I think that's one, not something that's like expanded upon. Like, it usually starts with something's better than nothing, right?
Yeah.
And it's the same thing with loans. You know, someone always asks me, how do I improve my credit? Well, make your payments on time.
Yeah.
You know, it's like, I know. I'm like, well, that's better than nothing, right? And then we can go through some of the other, you know, strategies. But I think when it comes to that specific topic, like people, what advice do you have for analyzing someone's budget to save properly? Because I think a lot of people nowadays don't save first. They save what's left over. So I'm curious what your take is on that. Because if you don't know each month like how much you're going to save, then how do you know how to allocate it? You don't even know how much you're going to have.
Yeah, and I think you kind of hit the nail on the head where, you know, we typically would even go through this vignette, we call it, through our process of like someone that's financially dependent and someone that's financially independent, right? Those that are financially independent, they get paid, the first thing they're doing is saving, right? Then they're hitting their fixed expenses, then the discretionary spending comes after that. Versus other styles or ones that we won't find to be as successful as I get paid, I do my fixed expenses right away, then I do my discretionary spending, and then whatever's left over I might be able to save, right? When it comes to budgeting and trying to gear up for a home purchase, I think the first exercise is obviously just creating a budget, right? And when I say a budget, I mean of your true fixed monthly expenses, right? Rent, student loan payments, car payments, auto insurance, those groceries, those bills that you know are going to be coming out every month, right? Figure out what that number is, right? And then you might want to get into your pay stubs and determine like, what is my net of tax monthly income? And let's see what that excess amount is, right? Let's say that your net monthly income is $6,000 each month and your fixed monthly expenses is $4,000. All right, there's that $2,000 left over. I'm not naive to the fact you're not going to save all $2,000 that I wouldn't even recommend you do. You work hard. You should be spending your money on some things that you enjoy. But can we carve out or automate some sort of savings plan, whether that be to, like I said, a high yield savings or a non-qualified brokerage account where it's $250 a month or $300 a month that's just automatically coming out of your checking. Then all of a sudden 2, 3, 4 years later, there's where that down payment's coming from, right? And you're not dealing with those early distribution penalties you experience with 401ks, IRAs, or some other retirement accounts.
Yeah, that's I think it's awesome advice. Because I think most people don't hit that step, and everyone's done it. You know, you get in this situation where at the end of the month you're like, where'd all my money go?
Yeah.
Like, I made X amount this month. Like, where did it all go?
Yeah.
And I think there's two contradictory feelings when that happens. Like, number one is someone with a really good financial plan will say that. Yeah. But the difference is where the money went versus the other person who goes, where'd my money go? And they look and it's in none of their accounts. Like, I think a really solid financial plan, and it's similar to like the analogy you probably see on like Instagram where, I forget the exact terminology, but it's like being rich is loud, wealth whispers. Or I forget the exact terminology. But I think that's part of the strategy too, where it's almost like it's a long-term investment. It's a long-term strategy. So it's very much a sleeping type of strategy where sometimes I look at my account every month. I'm like, where did my money go? Yeah. So my checking account has $1,000 in it. I'm like, I should have more than $1,000 in it. Yeah. Then I realized, X amount went here, Y amount went there. Yeah. And those are all part of my plan and I know why I'm putting it there.
Yeah. And I think the other thing is like, back to that philosophy we touched on of like, you get paid, the first thing you should do is saving is, your spending behavior is going to change so much if you've already put the money away and there's less in that checking, right? I think the other thing too, when you asked what would be recommendations on how to get a control of how much you're saving or you're budgeting, I think reviewing your credit card statements, every so often, every couple months, is really important because you start to realize like where that discretionary spending that could be cut back if you're starting to get antsy or maybe I guess you're getting impatient on, hey, I'm still renting, I want to buy a home. Well, review those credit card statements, right? Like, there's most likely a lot of transactions that are going on in there. When you look back a couple months, you're like, wow, I spent that much on, whether that's food delivery service or at, retail shopping, other subscriptions, and like, am I even still using this app, right? Yeah. So I think that's another really good exercise that I tend to do with my clients, on a semi-annual or quarterly basis is, we're always updating that budget, and I'm always having them go through those credit card statements and trying to determine, all right, what's the one place we think we can cut back on some discretionary spending over the next few months, right? And it's almost a new expense that we're going to try to touch on a couple times a year. and then all of a sudden we maybe carve out an extra couple $100 a month that we can put away, and then it just really, really helps put them in a better position to come talk to you in due time and kind of reach that big first financial goal.
Yeah, absolutely. And I think especially too, when you can trim up some fat, then you can reallocate not only to investments, but like paying off debt.
Yeah.
And I think that's something that people don't like always focus on. At least some of the clients that I see on the credit report, they might have $50,000 in the bank, but like $20,000 in credit cards. Mm-hmm. I'm like, oh, but my money's earning 5% interest in a money market. I'm like, that's great. Obviously, my role isn't necessarily your role, so I don't really advise.
Yeah.
I have conversations, and of course, if they ask my advice, I'll give it to them. But that's not really my position to critique their financial plan. Yeah. But in my head, I'm like, if that were me, I would immediately have $30,000 in the bank and no credit card debt.
Yeah.
So I think the debt conversation is interesting too, because obviously I'm focused on loans, right? Mm-hmm. I give out debt for a living, and I'm a real estate investor. So when someone asks me, do you like debt? I say, I love debt. It just depends on what kind and how you're going to use it.
Yeah.
So I'm curious on your thought about like good debt versus bad debt.
Yeah.
Because I think people tend to label it in one bucket or another.
Yeah.
But I think it really just depends on like how you're going to use it.
Yeah.
So I'm curious what your take is on that, and how would you kind of evaluate good debt versus bad debt?
Yeah, great question. That's a big topic of conversation with our clients, and that's somewhere that I find the education is really valuable on good debt and bad debt. Good debts are things like what you do, mortgages, right? Even student loan debt, right? If it's helping you get a degree, it's helping you advance in your career. You have mortgages, student loan debt. Those are some good debts typically for a couple reasons. One, they tend to be lower interest, right? Two, there might be some tax deductions you can create off of that debt. And three, they're usually helping yourself leverage to get to another point in your career or life that you're trying to reach, right? Bad debts would be, debts like credit cards, personal loans. Depending on the situation, maybe a car loan. Not all car loans, but people maybe overextend themselves in that area. I'm sure you see it when you're doing your underwriting process and reviewing people's financial situation to approve them for a loan. And this is what their income is, and they're driving a car as if their income's maybe a little bit more. And again, those are bad debts for typically the much higher percent interest rates that is on those debts. And those higher interest rates just make it so difficult with how expensive just life is today to get those debts down on a monthly cash flow basis, if that makes sense. When you amass a certain amount of credit card debt, it's really, really difficult to just pay that off on a monthly basis depending on how tight your budget is, right?
And the interest rates are high.
Yeah, and I think the other way to think about it is like, let's say, for those that were lucky enough to lock in a mortgage in 2020 or 2021, they have 3% interest rates, 2.75, whatever that is. A good debt is one where you're actually okay letting that interest accrue on that loan because you can redirect excess cash flow into a different vehicle, whether that be an investment or even, heck, money markets and high yield savings are even out earning some of those mortgage rates that a few people have from 2020 and 2021. My point is with good debts, you're not in a rush to pay those off because you can put your money elsewhere where you might accumulate, whether that be investment gains or interest from just money markets or high yields that's accruing at a faster rate than the interest that's accruing on the debt over here, right? Whereas when you start to look at a credit card that has a 27% interest rate, I would love to say that that's something that we could confidently beat on a rate of return, but it's not, right? I mean, we can't confidently say that over a number of years, dollar cost averaging into certain investment vehicles that we're going to out earn over here on the investment side what is accruing on your debt side when it comes to the credit cards and personal loans and things like that. So that's always a big conversation too of like those that graduate, and depends on the student loan situation, because trust me, like we see student loans at 12 or 13% interest rates, right? Big reason why we partner with other people to help refinance those and get those down. But those that do have student loan debt and are a little bit younger and they have that really big financial goal of buying a house, sometimes rush to pay off that student loan debt, where it's actually at maybe like a 3 or 4 or 5% interest rate, and they could be kind of building up this savings account over here that's going to help them kind of get to that financial goal of buying a house sooner, because they have the down payment, they have the reserves left over after, you can still buy a home with some student loan debt, right? It's all going to be based on that debt to income ratio. And as long as you're keeping that in mind with your repayment strategy, better position.
Absolutely. And I have that same conversation with some people on the mortgage side. That's one where I do actually typically comes up often.
Yeah.
And it's the idea of someone will have, say, $10,000 in student loans. They go, I'm going to pay those student loans off before I buy my house. And I'm like, so I talk to them about the student loan. I'm like, what's your thought process? And they're like, well, it's either really one of two camps. Like one, someone just wants to get rid of the debt before they buy a house. Like, okay.
That's fair,
it's merit. You can justify that. You have the other camp who's like, well, I want to pay it off because I don't want to keep paying interest on those if I'm paying on the mortgage. And I'm like, good point, but you got to look at the numbers.
Yeah.
So what's the interest rate on your student loans?
Yeah.
And if it's people that are like, oh, it's 4 or 5%. Like, well, you're going to borrow money at 6 or 7% on a mortgage. So you're better off paying the student loans monthly and allocating that $10,000 towards the loan.
Yeah.
Because two reasons. One, the student loans you're paying off quicker usually.
Yeah.
Mortgage you're keeping for 30 years, which most people don't even keep it for 30
Exactly,
years.
yeah.
But you'd rather pay off the debt at 6 and 7%, put more down on the mortgage than 100%. If you just pay off your student loans.
Yeah, and I just think the biggest reason that younger professionals, those in their 20s and 30s, and it's why the average first-time home buyer is 37 or 39, 30, somewhere. 38. Yeah, somewhere in that range. It's the ability to accumulate and amass liquid savings. And sometimes if you're not really thinking about it or putting together a strategy, you're just throwing money to this bucket, this debt, that account, and there's no intentionality behind it. And I always want to try to help my clients that are still gearing up for that home purchase. What is our number one objective? That is build those liquid savings. Let's review your debts and determine which ones are a priority to pay down quicker than others. Because like you said, if someone has $10,000 of student loan debt over here, but they got $10,000 in a high yield savings over here, well, you could, in theory, just pay them off in full, but does that really make sense to take that $10,000 and just throw it to the bank? Now that $10,000 can't do anything for you in terms of down payment, reserves left over after, any money you need to dump into the house upon purchase, closing costs, things like that. Once you give that $10,000 to the bank to pay off your student loans, it's gone, right? The opportunity cost of that $10,000 is out the window, and I think these are the type of conversations that you and I tend to have collaboratively with our clients, which has been very rewarding over the last few years. So,
especially with how interesting the interest rate landscape has been. Yeah. And I think, I had some clients during COVID. We had some equity line products that interest rate was 1.99 fixed for the first year. Mm-hmm. So people take $400,000 or $500,000 out of the house, they'll take it out at 2%. Yeah. And they'll go put it into the market, which obviously the market did well the last few years. Yeah. Or they'll put it in just to a high yield savings account. Yeah. Or a money market. Yeah. And you're making the spread. Yeah. So I think there's a lot of smart ways to use debt. Yeah. I think it's important to talk to someone who can give you that advice, because I know for me, I always joke, like, I don't really care what the rate is. Mm-hmm. It just depends on how I'm using the debt, right? Like if I buy a rental property and I'm borrowing money at 9%, like granted it's going to be lower than that, but let's say it was. If I'm borrowing money at 9%, well, if the property I'm buying still provides me the return I want while covering my debt cost, it'd be nice to have a lower rate, right? Increase your margins, make more money, but I'm not really repaying the debt. The repayment's kind of outsourced to my tenants. So, I know people who buy the fix and flip, they'll buy with hard money. Yeah. The interest rates right now are like 13%. Yeah. My brother lends for private equity. They lend at like 16%. Yeah. But the person who's buying the debt understands that they're out, their exit plan still puts them in a position where if they account for the debt cost, they analyze their profit, and based on the cost of their debt plus the cost of acquisition and all that stuff, they're still making a significant profit. Yeah. So it's just the cost of debt's important, but it's more so like how you're going to use it and like what's the opportunity cost otherwise. Yeah. Especially in the personal finance realm. So.
And I think when it comes to good debt and bad debt, it's just one thing that we always want to try to eliminate credit card debt. And if that could be like one thing that people take away from listening to a financial planner on this podcast, is like that is something that you want to try to avoid at all costs, because the amount of times that we have clients reach out and find themselves in financial hardship, that is one of the number one reasons that they are, and one of the most difficult areas for us to be able to help them get out of, right? Because you're limited in what you can do. Sometimes hopefully they maybe have a lot of equity built in their home, and we can, maybe take out a HELOC at 7, 6, whatever % there, and then consolidate the credit card debt and free up some cash flow to just, now chip away at the HELOC or maybe save a little more. But that would be just one area that I think it's really important for, people that are just kind of getting started and planning for their future on their own. It's really easy when you see that credit limit to kind of, enjoy yourself and spend a little more, but it's something that can be very, very, it can just really help or really hurt someone kind of when it comes to trying to purchase a home one day. So.
Oh, absolutely. And I think it's hard if you don't have that like set plan, or at least whether it's a plan or even if you're just someone who needs like boundaries. Like obviously everyone should have a financial plan, but you need something to just keep you in line. Like the bumpers on a bowling alley. I actually use that in the earlier episode I filmed today. So if you're listening to these back to back, I'm sorry, I double reference up my repertoire. But I think you need those bounds so you can bounce back and forth. And like whatever your strategy is, you need to be able to recognize in your finances that you have a limit, right? Yeah. So I think credit cards, sometimes you don't see it. It might not be, if you have a Discover card and you bank with Bank America, like every time you open your checking account, you don't even see your credit card. Yeah. So you got to be like checking your statements on it.
100%.
Now I know we talked a lot about like debt. So obviously debt structuring in terms of managing interest rates, interest costs, and a little bit about 401k, plan management, fund allocation. But what are some of the other things that you and your clients talk about that you and your firm are able to speak on?
Yeah, I would say when it comes to simplify it, right? I would say that what I help my clients do is I help them plan by design rather than plan by default. And really what I mean by that is plan by default is I have my 401k, I pump money into that, I save to cash, I ultimately spend that cash a lot of the time. I might even, many people these days are, doing more than that too on their own, right? Maybe they have Roth IRAs or they have other investment accounts, but they're planning by default by that there's no strategy behind it, right? Planning by design is what are your goals? Where are you looking to accomplish in the next 3 years, 4 years? All right, let's get into what your annual income is, what your fixed expenses are, what % of your income should go to that 401k and why? What % should be going to your high yield savings and why? What % should maybe be going to a Roth IRA or other, whether that be investment vehicles or other accounts to consider? And just having that intentionality, as I mentioned earlier, is really, really important. So, from a high level, areas of focus for us as a financial planning firm in terms of what we're assisting our clients with is cash flow and budgeting, number one, getting into the weeds of that and helping clients understand what they are spending, how much money they are leaving on the table with some discretionary spending, and how can we recapture that and then be putting it towards some wealth building vehicles with investment accounts, right? 2 is that just investment management, right? There is plenty of places that you can hold your assets these days. And I think as long as you're confident in your strategy and you're not being emotional with your investing, the last couple of weeks is a good example of that, then, all the more power to you to do it on your own. But for a lot of clients, they want that guidance, right? They want to ensure that they have a well-diversified portfolio, that they're investing with professional money managers, that they have several different holdings that are allocated to domestic equities, but also international. Do I have fixed income in there? And that's all dependent upon age, time horizon, and things of that nature. But the investment management's a big part. Something we haven't talked about, as much so far in this interview or this podcast is protection planning. When I'm working with a married couple, like my job is to help ensure, God forbid something happens to spouse A, that spouse B is going to be okay, right? That their kids are still going to be able to go to school one day, that they're still going to be able to pay off that mortgage or stay in that house, right? So, areas of focus with protection planning being life insurance planning, any disability insurance planning. You get some benefits through your employer, but a lot of the time they may not be as sufficient as we would tend to recommend from a financial planning standpoint. So that's another big area. And then the other also important facet is estate planning, right? I'm not an estate planning attorney. I'm not drafting up those documents, but you really would want your financial planner to be working in cohesion with your estate planning attorney as you get much older, right? To ensure that all of your assets and accounts are titled correctly, right? If I have a trust, which accounts and which investment vehicles that I have should be owned by the trust, which one should have the trust as the beneficiary. So there's a lot that we can do for our clients, and depending on where people are in their financial journey, we might be doing all of those things I just mentioned, but then you also might be someone that you're not maybe thinking about some of those protection planning or estate planning items just yet, but at least I'm there to educate you on it and tell you what's important to consider, and then at that point they can make that decision if it's something that they think is applicable to them at this point in their journey, as I mentioned. So,
and I think that's like usually I feel like a big barrier for someone to speak to a financial planner, because they think, and the same with mortgages, right?
Yeah.
They think like they have to have everything already figured out for you to then like work with it. Like they need to have X amount in the bank. Yeah. And for me, it's always they need to have a perfect credit score and have $100,000 liquid to buy a house, which like it's actually the inverse. Like you should talk to them much sooner. Like when should someone talk to you about financial planning? When do you start that conversation?
Yeah, I would say you can start that conversation as soon as you start earning an annual salary, or you're working full-time in your career, and if you are someone that cares about making progress year over year and trying to reach your goals, you should be talking to a financial planner, right? I think you made a really good point of like, sometimes there's that barrier to entry, or people think there's a barrier to entry, like I need X amount in assets to even approach Matt or approach his team. But we will have an initial conversation with anyone, right? It doesn't mean that everyone's the best fit for our office, but for me, I really, really enjoy having those people come into our office that maybe don't have a ton built up in assets yet, but by putting some intentionality behind where they're saving and how much and helping them invest, and then 3 years from now, being able to look back on the progress, like that's the most rewarding experience for me as a financial planner, right? That's where I think my impact is the most crucial, is helping people get to maybe that point they thought they had to be at to talk to me in the first place, right? Because I think that is something that I run into a lot where, I had another young professional, around my age in his late 20s approach me and say like, why would I want to consider working with you? And I said to him, I said, for you, if you have confidence in why you're saving a certain amount to your cash, a certain amount to your 401k, a certain amount to your IRAs, right? You have, an idea of when you're looking to buy a home. You have a bunch of confidence within what you're utilizing in your group benefits and how you're ensuring you're protected outside of those, then maybe we don't need to connect just yet, right? However, the amount of people that have all that kind of shored up just completely on their own, it's not as many as you may think. And I think that there's just a lot of people that could benefit, at least from an initial conversation. The worst case is that they walk away feeling very confident that they had a financial planner say, hey, you know what, you're doing a great job, right? But a lot of the time there is some areas, like we always tell people, whether you work with us or not, you're gonna build wealth, right? You're gonna make money, you're gonna save, you're gonna invest. You just have this bucket that might have some holes in it that we're trying to essentially plug, and help you be as efficient as possible within your financial planning.
Yeah, I think that's a really good way to put it. That's the same type of logic I use for the mortgages, which I think it's entirely true. Like I always say, when someone's ready to think about buying a house, say one of two things is going to happen when you call me. Yeah. Either we have a conversation and I confirm you're in a great position. Yeah. Your credit looks great. You're in a great position as far as what you've saved for down payment. Yeah. Take the time, whenever you're ready, give me a call back. But worst case, we do have a conversation, and I point out some areas you can improve upon so you are in the best possible position when you are ready to buy. Yeah. But either way, you win. Yeah. So it's worth the conversation, because I do think even that person you mentioned who's in their late 20s and might think they have it figured out, they might, right? Yeah. They might have like a pretty good idea, and you might say, hey, why don't you think about this strategy or this strategy? And they go, oh, I didn't even think about that. Yeah. So there might not even be things that they're considering because they're not an expert in the field, right?
Yeah. I think the other thing too is people get older. If you're someone that manages your investments on your own, there's always that certain dollar amount for everyone. Everyone's dollar amount's different, but like when does that investment account value get to a certain point where you start to just be overwhelmed that you're doing all of that without any sort of second set of eyes or professional management behind it, or at least kind of ensuring that you're allocated the way that we may recommend or our investment team out in Boston may recommend, right? So I think that's another thing to consider for those that are like, should I reach out to a financial planner? And maybe you don't need that investment management advice just yet, but there's probably that dollar amount that you may reach at one point that all of a sudden it gets to be a little overwhelming that you're kind of tackling it all on your own. And the other thing is your time, right? Yes. Like within your day job, how much time do you have to be getting into the weeds of your financial plan as you're trying to help 10 to 15 people a day or whatever that number is get pre-approved, right? It's difficult. So having someone else to be able to do that for you, where you just have those quarterly check-ins and you kind of leave that office or that Zoom call saying, all right, I feel better now. Like I understand I'm in a good spot. And it took me, all it took me was an hour of talking to my financial professional, my financial planner, you know?
Absolutely, yeah. And I think that's something we talk about too, even with the accounts, I have with you. It's not, and when I talked about actually this on the last few podcasts, it's become a common theme, but like understanding that the capability to do something doesn't mean that you should feel an obligation to.
Yeah.
So like, for example, financial planning, like, there could be strategies I could go online and learn and research, and I could spend the time to do all of that. But then, like, what am I missing out on the other side? Like enjoying my life or my business to go earn more money.
Exactly.
I'd rather find someone who knows the field already intimately to have them assist me with this piece that they're an expert in, so I can go do things that I'm an expert in.
Yeah, I mean, it's like when I gave you a call a month or so ago, and I just got my taxes filed, and I don't want to go look into how that was going to apply to me looking at getting pre-approved and things like that. Like, let me call you and let the professional kind of give me the advice, and left that phone call feeling great in the sense that you were able to give me really strong advice on what to consider as I kind of go into the next year operating my business, and what I should consider when I go to file my taxes and how I can get pre-approved through different programs you offer. So
yeah, that's what it's all about, right? I think that's why we do what we do, to be resources for people. So staying on that topic of business owners, growing businesses, and managing efficient operations. I want to shift gears a little bit to something that we've started, which has been an awesome success so far this year. Connect Woo. Which I know it's been instrumental in my business in terms of just meeting more professionals, getting connected with people who I never would have otherwise been connected with. But obviously, we run that together. It's been a great time. But I want to hear your opinion. Like, how important has that networking piece been for you and your business? And what do you recommend for people who are starting their own business to start to build clientele?
Yeah. No. I mean, I would say that networking and having what we call, in my business at least, centers of influence. Right. Those other professionals around you that are keeping you in mind and kind of helping you grow, and you're helping them grow at the same time is very, very essential if you're starting a business. I guess I'll kind of first touch on the networking group and networking in general. I remember when you and I first got into our respective businesses, going to every event that there was, whether that was in Boston or Worcester or Providence or wherever, and at least we had each other to kind of do that with, right? But I think the other thing is just continue to show up and be there, whether that be a chamber of commerce or a young professionals group, or, Connect Who, the networking group that you and I have formed, along with a lot of other professionals and partners that have been a huge help with that. Show up, continue to be there, continue to build those relationships, because at the end of the day, in my opinion, obviously someone's professional advice and background is super, super important, but people really enjoy doing business with those that they just like. Right? Those people that they have good relationships with. And I think for me as a financial planner and getting into the profession at a younger age, I really had to rely on those relationships to grow my practice and grow my client base. Having a number of different people in different fields, whether that be mortgage lending or accounting or property and casualty insurance or real estate agents or, plumbers and electricians that either work with me individually themselves, or they have sent introductions my way where they've gotten positive feedback. It really allows you to kind of scale your business and not have to focus as much on that prospecting piece and the old ways of doing it, whether that be cold calling or door knocking and things of that nature. If you have those partners around you, it allows you to truly just focus on your clients and let the new opportunities just come in due time. So I mean, I would accredit pretty much almost all of my early career growth and what I would, I guess, define as success for myself, at least in my own standards, to networking and to building those referral-based relationships.
Absolutely. Yeah, I couldn't agree with you more. And I think it's just a much more like organic way to build business, but it's more fun for really everyone when you have those types of relationships where you just enjoy doing business with the people around you.
Yeah.
And then finding professionals who are really good at their respective business makes it doubly as enjoyable, which we've been really fortunate to, as this group has grown, like grow strategically so that like the professionals in the group are very good at what they do.
Yeah.
And it makes it very easy to make introductions because I've used almost all of their services in the group.
Exactly.
And I know that they're very good at what they do. So it's like when you build your network out strong enough professionally, making introductions, connecting with people, helping people becomes self-rewarding and so much easier because you know the person you're connecting to, someone you know is going to benefit greatly from the service they're about to get.
Exactly. I mean, it's the best feeling in the world for me when I'm in an annual review meeting and I have a client say, yep, this is the year, like I'm thinking about buying a house, and I just know that I can introduce that person to you, and I know they're going to get great advice and that they're going to get someone that responds in a very, very timely manner and that's super detail oriented, because it's an awesome reflection on me and my business now, right? And I know you talk about this all the time within our networking group, but that's really the biggest value add to being someone that's involved in networking and building those relationships is I'm a financial planner, but I've helped my clients find success in, an accounting relationship or in reducing their home and auto insurance costs because I have a trusted partner that reviewed their coverages, and the outcome's either one of two. One, hey, you're in a really great spot, stay where you are, your policies look good. Or two, hey, I can save you money. And then for me as the financial planner, like now I'm redirecting that money back into some more savings and investments. And that's just a specific example, but I'm super excited about the networking group that we've started. And for those that might be listening, we are just a single seat networking group based in Central Massachusetts that has grown rapidly in the last year from, 2-3 years ago, maybe 7-8 members in our group to now pushing almost 30 members, all in their own respective seats related to their business, meeting weekly where you have an opportunity to market yourself and market your services, tell client stories, and educate the others in the group on where you can, assist people. And then the goal of our group is for everyone to succeed, right? Everyone to get more introductions for their own respective business. That's why we track how many introductions and referrals are made. That's why we track how much revenue is generated from our group as a whole. And it's something that I think has been instrumental to, I guess my success, your success, and others that we work with in the past couple of years for sure.
So I know for me, like those connections have been so valuable, and not only from like the standpoint of the group's primary purpose, helping each other grow, helping each other, do more business, be more successful, but also like expand community connection. Like we're putting on local events within the Worcester community, getting other professionals out there who might not be like in the group, but they're getting familiar with our group. They're coming to the events that we put on, learning from great guest speakers, like we've had so far this year with David Hill coming to the AC Hotel in Worcester. And also just for like, again, meeting people that you wouldn't otherwise have met that will end up serving you later. So obviously, we now know estate planning attorneys, we have divorce attorneys. Don't really want to ever call the criminal attorney, or the divorce attorney, either or. I hope I never have to call him, but it's good to know I got him around.
But in all seriousness, you have clients that are dealing with that. I mean, it's a good introduction for them to have, but
it's
jokes
nice.
Aside, not someone we want to be calling ourselves.
No. Similarly with the plumber, I hope I don't have to call him because I don't want to have to
deal with
use the services, right?
With,
right? But it's nice to have those connections.
Yeah, for sure. I mean, I think when it comes to networking and trying to grow your business, I think it allows you to get out of your comfort zone a little bit too. You end up forming relationships with people that you think years ago, like you probably never would have, or maybe you wouldn't find yourself in this situation, at this different event or at this, whether it's at a restaurant or a bar, and you're just conversing with people that have such a different background than yourselves, but then you just build that strong relationship, and it's just a really rewarding experience. And then to be able to all come together and, like you said, make an impact on the community as a whole through some of the stuff we do around Christmas time, making sandwiches for the homeless and all the work that one of the members of our group, Dennis O'Connor, kind of helps facilitate. It's just, you're a part of something bigger than yourself at the end of the day. And I think, whether that's in your work and you feel that way, we get to feel it both within our companies, but also within our networking group as well. As you get two different areas where you're a part of something that's much bigger than yourself. And then it's a feeling.
And we enjoy the company. We have good people. We're very lucky from that aspect.
For sure.
But I do want to close things out here with a question that I try to ask everyone. I didn't prepare you for it, but I'm going to put you on the spot.
Yeah, let's hear it.
Always ask for top 3 or 3 book or podcast recommendations if they want to learn more about financial planning, financial well-being, financial health. You don't have to give me 3, but if you have 1 or 2 that come to mind.
Yeah, I mean, I think, I guess specific to financial planning, one that's kind of like, and I don't want to say basic, but like almost anyone can kind of get into, Rich Dad, Poor Dad. There's a lot of good lessons in that, but one that I really want to speak upon is called Total Sense. It's by a gentleman named Tom Henske. He actually is a representative within my broker-dealer, MML Investor Services, and he created this book, Total Sense, that is a children's education book related to financial literacy. So it really could help anyone from ages 6 to even people in their 20s and 30s on just very basic financial literacy topics. And like the book is very well written and set up to where, like, if you're a parent, you can read a chapter with your child before bed and you can work over time, and all of a sudden now your 8-year-old has the concepts of savings accounts, of compound interest, of debt. And for me, I wanted to speak upon that because it's just something that I thought was super cool when I was introduced to the book. I've met Tom Henske a couple times, and it's one that I send out to my clients, like all my clients that are, have those younger children. It's something that I try to get out to them and say, hey, take a look at this, potentially read it with their kids. I mean, heck, like I said, it's good education for anyone, but I like the fact that it helps empower and educate the youth on financial literacy, because again, that's a big reason I didn't feel like I had that kind of in my childhood and kind of why I wanted to get into this business. So that's kind of the one I'll touch on the most, is Total Sense by Tom Henske.
So I know you've talked about that book before, and it's I think that's a really cool concept of bringing in the household early, and something that I'll definitely.
It may not get our office, the people that are reading it, and like it may not get us the best clientele if it's geared towards children, but it's really good for our clients that we are working with that are gearing up for retirement to be able to educate their children, and then their children can now eventually maybe work with us one day when they graduate college or are starting to save and things like that, and they have those concepts kind of already a part of their their understanding, I guess, of the financial world. So
it must be cool to see it come full circle.
Yeah,
so,
for sure.
Well, thank you for coming on, Matt. I had a great time. I mean, I know tons of great tidbits in here for anyone who's listening, so I'll make sure.
I appreciate you having me.
Of course. I'll make sure I put all your contact information in the show notes, so if you want to get in touch with Matt, you can check out the contact information below.
Awesome.
And find him online. I'm sure if you Google Matt Ward, Ford Financial Services, you'll probably find him.
Yep, you will. So thanks, Ryan. I appreciate it, man.
Yeah.